question. Again, this is the mortgage question, and we have Carrie, Arthur, and Kim with us today from the United States Senate Federal Credit Union. If you have any questions while this presentation is going on, Carrie just made the announcement in the chat, but please post your questions down there, and I'm sure you all will be receiving a lot of insightful information, so please ask away. And with that being said, Arthur, you can go ahead and take it away. Thank you so much.
Thank you, Megan. Thank you for having us here. It's always good when we can do things with you guys at NAB. The credit union has been with NAB for a while. We're actually partners, so anybody who is an employee or a member with National Association of Broadcasters can be a member. So if you are not a member, to learn more information about that. And if you are a member, the easiest way to join the credit union is through family. So if you have family members, they can join the credit union. And we have lots of great rates. Mortgage rates are awesome right now, so that's why we're here, right? We also just want to let you guys know, mention the raffle. We're going to have a raffle at the end of this webinar. Carrie will be doing a raffle. We're raffling out $100 to a lucky winner, so stick around for that. We'll be doing that after the Q&As. But right now we're going to jump into the presentation. Megan mentioned Kim. Kim is our senior mortgage loan officer. We also have Jeremy on the call, who's a mortgage loan officer of the credit union. Kim will be doing the presentation, and just a little bit about her. She has over 20 years of banking and financial experience. Kim graduated from the University of Maryland's College of Business and Management with a bachelor in finance. She has a dual master's in business administration in Johns Hopkins University. Her work has included consumer mortgage and small business lending in this area. So Kim is very, very familiar with this market and everything that's going on in the market today. So, and she's a very busy lady with all of the great rates that are out there. So without further ado, I'll hand it over to you, Kim, and it's all yours.
Thank you, Arthur, so much. Let's get started. Arthur, if you could get me to the next slide, that would be great. My purpose for today's presentation is to help you to answer 4 common mortgage questions for you. How do you qualify for a mortgage in today's changing environment? How much house can you afford? What kind of mortgage is available to you? And what are the changes that you may see as you own a home over time? Let's start with what's happening today in this world. Right now, I would say that we are in a historically low rate environment, the lowest I've seen for the 20 years that I've been in the business. I also see the last few weeks that the rate is trending up, but still, it's still low. It still stay low. I mean, you're talking about, rate below 4% for a 30-year versus a couple of years ago, it's in the 8 or even 12% long time ago. It's still great rate environment where you could still purchase your home and a lot more home since the rates are low, so you can afford a lot more. More houses. The only challenge that I see these days is the inventory of the houses. But because of the rates are so low, you can purchase more homes. But then the challenge is finding a home that you like to purchase. Next slide, please. Let's talk about planning for home ownership. You do have to plan to figure out how you're going to save and how much you need to save, how much you're going to need for down payment, and how long you need to save for the down payment. So I would say, first thing you want to do is figure out how much you can afford, how much you need for down payment, and then you can plan ahead, create a system for the down payment. And always talk to, if you're in doubt, if you don't know something, you always want to do your research online, or you could always call a mortgage loan officer, such as myself or Jeremy at the U.S. Senate, and we certainly could help you with it. Let's talk about the down payment. Some of the typically most of the lender would like to see you put down as much as you can. Not most of us can't afford to put down 20%, but typically 20% will have you avoid paying the PMI. But it doesn't mean that you can't purchase a house if you don't have 20%. You can get into a home with less than 20%. If you have as low as 3% down, you can get into a house. If you're a first-time home buyer, you can down as low as 20%, and there is a mortgage program for you to be able to get into the home with 20% down. With 5% down. 3% down. I'm sorry. Minimum is ideally 20% to avoid PMI. If you really like the house and you do want to get into the house and you have less than 20%, you still can purchase a home. You do have to pay PMI, and PMI is what stands for private mortgage insurance. It's an insurance policy that protects the lender in case you default on the payment. So unfortunately, you as a borrower will have to pay for that premium, and then the lender is the beneficiary if something goes wrong. But like I said, the PMI will let me back up that you can get into the house with PMI, and the PMI you can always cancel the PMI in the next several years. After you accumulate 20% of the equity, and then if you pay into the PMI for a certain number of years, you definitely can cancel the PMI. So that way will allow you to get into the house that you want. Paying down debt. You do have to pay, you should consider when you start getting the home, start thinking of buying a house, you want to minimize your outstanding debt. You want to pay down as much as you can so that you can be able to qualify more for the home purchase. So I would recommend when you start thinking of buying a house, don't go buy a brand new car. Pay down as much debt as you can. So you have to plan if you need to plan for that, that's what I would definitely recommend you to do. Next slide, please, Arthur. Home decision. How much can you afford? How long should you stay in your house? And what does it look like in long term? In terms of how much you can afford, I would say, we typically do 4 to 5 times your annual gross salary for your loan amount. So it's also dependent on how much you have in down payment. And how long you stay in the house, how long you can stay in the house determine how much of the house you want to purchase. If you think that you can stay in it for 30 years, then definitely, you would want to buy that, nice house that lasts you for 30 years that you want to stay in. Typically, most people stays in their house 7 to 9 years, and then they'll upgrade their house. With that in mind, you can do, shorter term mortgage, or you can do what the typical most people would do to start up the home purchase is to do a 30-year mortgage. In a long-term look, I would say purchasing a home is a asset. It's a form of an asset accumulation. It's a soft equity cash savings account for you. As long as you pay into the house, eventually you pay off the house and the house belongs to you. So that's your asset that you can certainly use later on to, if you ever needed to sell the house, to give it to your children or your heirs, or you can borrow against the house later on if you needed some cash. That's what I see as a long term. Always want to buy a house. Next slide, please. And what does it take to purchase a house? I would say you would have to pre-qualify or pre-approve with the lender before you even go see an agent. These days, if you're shopping for a home, and you start talking to an agent, the agent will always going to ask you whether or not you have been pre-qualify or pre-approved by a lender. So you would want to do that as your first step in purchasing your home. I would recommend you to call one of us, Jeremy or myself, at the U.S. Senate Federal Credit Union, and we would be more than happy to help you pre-qualify you. We would need you to fill out an online application. We would need to check your credit report and then see what kind of debts you have, and we can work all those run the numbers for you. Ideally, right now, you would want to have a minimum score of 680. The higher the score, the better the rate you'll get, and the more you'll be able to qualify for based on your income. So income is a consideration as well beside credit. So income and credit are the two factors that we use to pre-qualify someone to purchase a home. Typically, we would say that you would want to do 25% of your gross income towards your mortgage payment, and then don't go any higher than 36% of your total debt service of your income. Next slide, please, Arthur. Before you shop with pre-qualifying total debt, like I said before, you would want to pay down as much debt you have before you start buying your house. This is also depending on your income as well. If you can stay within the 36% of your income, with your total debt, then you're fine in purchasing a home on that. But if you feel that you need to pay down more debt to buy more house, then definitely you would want to do that. Cash for down payment. Cash for down payment, you do have to plan and save for. As much as you down, the better you can, the more you can buy from the home, the more you can get for your houses. But like I said before, you don't have to have 20% down. You can do as little as 3%, 5%, or 10% down. You can also, with the cash down payment, you can also withdraw from the 401k. If you're a first-time home buyer, you can also get a gift from your parents or any immediate family for cash down payment. Yes, cash down payment source. Next slide, please. Choosing your home, definitely I would choose the home where you think where you live currently, if you like the area. What's the value around the area? Was it affordable? The school system, if you have kids. Properties, you have to consider the property tax and the homeowner insurance when you're purchasing a home. There's a lot of there's a lot of public sites that you can check out the property tax in the home that you want to buy. You also can call multiple major insurance companies such as Geico and State Farm or Allstate to ask them, inquire about what would it cost you on a monthly basis for home hazard insurance if your house is, say, $500,000 value. They should be able to give you some estimate of what that would cost you. But definitely when you choose a home, you want to choose the neighborhood that you want. And you browse and you look for a house that is affordable, the school system, and the taxes you want to consider, and also hazard insurance. Next slide please, Arthur. How much home can you afford? Typically, what I would say is you would do up to four, maximum no more than 5 times your annual gross salary that you could do. You can do on your home purchase price. On the slide right there is the link, and the easiest way to do is if you copy the link and just click on it on the web, and then it will take you to the mortgage calculator where you can plug in the numbers, and then we can and the calculator will tell you exactly how much you can afford on a monthly basis, as well as what prices of home that you can afford. Next slide, please, Arthur. These are some various type of mortgages. We have right now on the screen. We have a 5-year interest only payment, 15-year, 30-year. There's additional types as well, such as the 10-year ARM, 10-year adjustable, 7-year adjustable. We do have 20 and 25. There's as low as a 10-year fixed rate as well. It depends on what you need, and we can figure it out for you which plan is the most appropriate for your need at the time when you want to purchase your home. On the interest rate, I want to go down on the left-hand side, talk about interest rate. Typically, the interest rate, say right now, is 3.25%. Well, I'm just going to do the 30-year, 4.25 with 0 point. And some people want to know what's the point. The point is it's a fee to the lender. You can use the point to buy down the rate. So, for example, right now on a 30-year fix, it's at 4.25. So if on a particular day you said, well, if I was to pay 1 point, which is 1% of the loan amount, how much can I get lower in interest rate? So we would say 1 point, if you pay 1 point, you can go down as low as 4%. So if you're going to stay in a house for 30 years, it's better for you to pay the point to get the lower interest rate, because ultimately the interest payment is a lot less on a 4% versus a 4.25 over a 30-year period. Fees is what we would consider as origination fee. It's a processing fee that you pay toward a lender. It's a one-time fee. It has nothing to do with the rate. It's just the processing fee. Down payment 20% is typical. It's ideal, but not a requirement. Okay. Next slide, please. Mortgage decision for changing time. So we are into changing time. It depends on what you need. If you want to get, right now we're in a low environment and a lot of people want to get in to purchase a house, get the mortgage. Based on your income, you can typically get a 30-year, but since rate is so low, you may want to consider get a shorter term mortgage, such as 25 years or 20 years or 15 year. And sometimes it depends on what your need would be, and then we can decide with you which is the best plan for you to get into the house in this changing world. Next slide, please. Now that we're in such a low rate environment, a lot of people want to know if they should refinance their home. Ideally, typically, rule of thumbs would be if you should refinance if your current rate is if the current rate is 1% lower than what you currently have on your mortgage. So, for example, if you currently on your mortgage is 5% and the rate for today right now is 4%, you definitely would want to consider refinancing your home. And you want to contact a mortgage loan officer, and we certainly could run the scenario and do some comparison to help you to see whether or not you do save some money or you don't whether or not you save some money. And most likely you will save some money because the interest rate's a lot lower. The other thing that you want to consider, whether you want to refinance or not, you can also consider going from a 30-year to a shorter term, such as 25, 20 years, or even 15, staying at the same payment, but the shorter term, which means that ultimately you pay less in interest at the end of the term of the loan. Next slide, please. Home ownership is it's not a retirement plan. It's not like a bank account for you to go in and get cash out, but it's definitely you want to include home ownership and home mortgage as part of your planning for retirement. Typically, most people want to get a loan, pay off their house by the time they retire. And to me, that is what we call what I say is a soft cash savings. You save once you pay off your house and then you build equity in the house, that is totally yours to use later on if you ever need it. But I would, but remember that it's not a retirement source. It's not a bank account, so you really can't go in there and take a lot of money out, because you want to, when you retire, you have limited income, so that you have to be careful of what kind of debt or liability you're taking out. So in summary, I would say the rule of thumb is that don't spend more than 25% for your home. You want to go ahead and save at least 20% towards your retirement, 10% on your savings, and then 10% for educational purposes. And these are standard guidelines. And I would recommend you talk to a financial planner or a mortgage loan officer to help you go through the mortgage process. And I think next slide, please, Arthur. I thank you for listening to me. If you have any questions, please do not hesitate to email me or give me a call, and I will be able to run some scenario for you and walk you through the process of pre-qualifying or refinancing.
Thank you, Kim. That was very great. Lots of great information there. Carrie, do we have any questions?
Yeah, I have a question in the chat box. How do you expect the mortgage rate environment to be around this time next year?
Well, if I can tell you that answer, then I will be rich. I don't know what to say, but I would say the market and the Fed indicated they will leave the interest rate as it is. So I don't see a tremendous increase in rate that would throw us off of the affordability purpose. If there's any move, it would be move up very little. It wouldn't move too high. I mean, it wouldn't go anywhere higher than what it is today. I cannot see it go like from going where we are today, say around 4% to like 8%. If there's any movement, it would be just a very little.
So that being said, do you recommend a fixed rate or a variable rate mortgage? Because of the environment that we are in now in such a low rate, I always would recommend you to do a fixed rate because it's easy to budget rather than variable. Even though the variable rate will stay fixed for that particular amount of time. So, for example, if you're getting a 5-year adjustable rate, that first 5 years stay fixed, and then after that, your rate will change on an annual basis. But the rate on a 5-year versus with the 30-year mortgage these days, it's practically the same rate. It's not a big difference. So for me, I would personally recommend everyone to go to the fixed rate because it's easier to budget. Okay. What's the lowest amount, or what is the lowest loan amount the credit union offers?
We would not do anything less than $50,000.
And what's the highest jumbo?
It all depends. I've done loans at $2.5 million before. So it depends on your credit score, your relationship with the credit union, how much is your down payment. We can go as high as right now, the highest I've done was about $2.5 million.
All right. If nobody has any other questions.
Kim, I actually have a question. You mentioned the 3% down, the home ready product. Who
Yes.
qualifies? What does the profile look like for somebody who would qualify for something like that?
You do have to be a first-time home buyer. Your credit score does have to be above 680. And that's pretty much all you really need is to be first-time home buyer and with a credit score. And the only thing is the debt income ratio cannot exceed 40%.
Okay, and the 3% down, you're not required to have PMI with that?
Anytime you do 20% down, there is PMI involved. So to answer your question, there is PMI with 3% down.
Okay, all right, so it still does require it.
Yes.
You mentioned the different types as far as terms of mortgage loans, but the different types like VA, FHA, those types of loan types that we offer. Can you talk a little bit about those?
Yeah, so we have what we call conventional and government loans. Government loans would be the VA. You have to be a veteran in order to qualify for VA. And the VA loan, you can either, you can get into a house or purchase a house with no down payment. With the FHA loan you do have to have your down, minimum of 3.5%. And you also, I have to tell you that FHA loan is 3.5%. You do have upfront PMI and monthly PMI. With the VA loan, you just have to have a funding fee, which it depends on your status of the being veterans. And then you can either, I don't know for sure exactly what the funding fee is. It all depends on your status as a veteran.
Kim, what is the 30-year rate there?
I'm sorry?
You know the 30-year rate today?
30-year rate today, are you doing a purchase? It depends on whether you're doing a purchase or you're doing a refinance. I would say average is about 3 to 3.5%.
Okay. So.
All right.
Benny,
thank you for all of that. Thank you for your questions. I'm going to hand this over to Carrie, and it will be raffle time.
So if I can get it to work, I'm just going to share my screen, and I put everyone in attendance, not USSFCU employees, of course, but all the NAB employees into this virtual prize wheel. I'm just going to spin it, and then the host disabled participant screen sharing. Can you put that back, Arthur?
Yeah, I just gave it to you, sorry.
And then so I'll just email the person who wins, because I have your email address from the registration list. And then I'll just ask you how you want me to get you your gift card. Hopefully you'll choose the E option, whatever it is, but we'll just work it out. But it'll be $100. Can everyone see my screen?
Yep.
Okay, one. No, I won't do it. Here we go. I'm just gonna click it. Daniel McDonald. Okay.
Woo-hoo!
So that was fun.
We have our winner.
All right. So I'll get in contact with you. All right. Well, thank you, Megan, for having us.
Awesome. No, thank you all. NAB, thank you all for joining. Congrats, Dan and Carrie. Just want to say a special thank you to you. Thank you for always reaching out. We love the seminars that you send and the recommendations, and this was a great one. So Kim, Arthur, Carrie, thank you all.